What is going on, guys? Marc Guberti here. In this video, we're going to talk about selling put options. Some people use this strategy in the stock market to make hundreds of dollars a month, even over $1,000 a month. It's a dividend investor's best friend and something you should definitely consider because it expands the possibilities. We'll also be talking about two different examples just to walk through the concept so you have some options trading strategies around selling puts. So if you do happen to enjoy this video, make sure you subscribe. As you can see here, a lot of people who watch the videos on the channel are not subscribed, and it really helps with the growth if you decide to subscribe to the channel, but only do so if you happen to enjoy this video. So selling puts, basically you are agreeing to purchase 100 shares at a set price, and for making that promise, you get paid a premium for doing so. So we're going to walk through Pinterest first as an example, because you don't just do this with dividend stocks. Some people, they like to do this with dividend stocks. Other people like to do this with growth stocks. The growth stocks tend to have higher premiums because they are less predictable when it comes to stock price. Like they could move around a lot more dramatically versus a dividend stock like AT&T, which usually hovers strictly in the $30, a little above, a little below type of range. So using Pinterest as the example, we're going to look at a 68 strike price put that expires in roughly 10 days. And if you were to sell that put right now, you would have to put in 6,800. You need to have enough money up front to buy 100 shares of the stock at the set strike price. So it's not what the stock is currently valued at, it's what the strike price is. So $68 per share would be the strike price. You have to put in 6,800. In this example, you would get a roughly $230 premium. And there are two different things. There is the bid and the ask. The premium you actually get from these is the middle of those. So just take the average of the bid and the ask. You get what's called a midpoint, and that is how much you will make in premium for selling that option in most cases. So you sell this option. Now, a few different things can happen. One, Pinterest goes up to, let's say, $73, and it stays there over the next 10 days. In that case, the option expires worthless, but you get to keep the $230 premium, and you get the $6,800 that you could reload, put that into another Pinterest put that you sell to collect even more income. One of the bad sides to this, there are actually two bad sides. One is if Pinterest stock goes up to like $80 and $90, like let's say there's just some like really amazing news about Pinterest that comes up within like the next week, you don't get that ride. You get the premium still, but you don't necessarily get the boost in shares. Selling put options is a way to get the guaranteed income, which is very desirable for a lot of people who are of a dividend investor mindset or just want some extra cash flow. Now, what if the stock goes under $68? Let's say the stock goes to $65. Pinterest doesn't have a good stretch over the next 10 days. In that case, you have to buy the shares at $68 per share, even though the market is saying that Pinterest is only worth $65 per share. Now, you will have the premium that cushions you for a little bit because you're not necessarily buying 100 shares of Pinterest at $68 each. Those 100 shares actually have a cost basis of $65.70 because of the $230 premium, $2.30 per share. So that's something to think about when you are choosing what strike price, because the premium affects the cost basis of your shares. It affects them for taxing purposes. It also affects them for profit purposes. So if Pinterest stock goes down to 65, you don't lose $300 because you bought at 68 when you could have bought at 65. You only lose $70 because you may have bought the shares at 68, but you got the $230 premium for making that purchase. And if you like Pinterest, you should be fine with that because the stock will just keep on running up. And you only do this for companies that you truly believe in rather than companies that just offer juicy premiums. So if I got assigned a bunch of Pinterest shares, another 100, I wouldn't really mind so much because I believe the stock has a great future. And again, this is just within a 10-day stretch where you put in 6,800, you get an instant 230 out of that. That's roughly a little over 3.3% when it comes to the instant cash return you get from that. Compare that to a lot of dividend investing strategies where a 3.3% yield across your entire portfolio will be pretty solid. You get that within 10 days, and you can keep on doing it over and over again with Pinterest put options and options for other stocks. The second stock we're going to look at is Upwork. A lot of stocks that do options, they do weekly options, but there are some stocks like Upwork where you don't get the weekly option play, you get monthly options. So instead of 4 expiration dates per month, with the only exception being the SPY, where they have 3 options expiring each week. But in any event, most options you get 4 expiration dates each week, sometimes 5 if there happen to be 5 Fridays in that particular month, because all these things expire on Friday. But Upwork, you only get 1 expiration date per month, and that's something to keep in mind. But the reason I'm bringing up Upwork is we saw what happens with Pinterest at a 10-day horizon, but now I want to show you more of a long-term element of options, because part of an options price is influenced by how far out the expiration date is. The further the expiration date, the more risk, the more uncertainty, and the more premiums for that. So Upwork is currently priced at almost $36. It's not quite there yet. And we're going to look at $35 strike price for January 2021, January 2022, and January 2023. Now, the way you get the highest return in options is, in theory, in theory, that's a big thing. In theory, you get options that are right at the money. They expire in a week. You keep guessing correctly, and that's in theory how you make the most money. But in between that time, like the stock could skyrocket or the stock can go down. The further out you go, essentially, the more guaranteed money you get up front. We'll walk through that example right now. So we look at January 2021. This is coming up very rapidly. And if you look at the $35 strike price right now, you get an instant almost 4.6% gain right off the bat just from selling a 35 put option. It's a $160 premium that you are able to get right away. This is $160 that you can put into Upwork stock. You can put it into an index fund. You can use this money right away. If we go a little further to the Upwork put option expiring in January 2022, we're looking at an instant $990 premium, and this is a 28% return that you instantly get. Now, a lot of people, they're really happy they get an 8 to 10% annual return. This is an instant 28% return, and then you either get 100 Upwork shares if for some reason Upwork stays at $35 and goes a little bit below that from now until 2022. Like the stock would pretty much have to be flat, or you had some slight downward movement to actually get to 35 for you to have those 100 shares. But you get an instant 28% return in $990 that you can put into other stuff. Some people, depending on what the premiums are on their options and what stocks they're looking at for selling put options, they'll take the premiums they make from one of their put options and put those premiums into a second put option for a different stock. So that's something you consider doing. January 2023, the premiums get even bigger. So $35 strike price, same thing, but now we're looking at a almost 40% return on your investment because you get $1,350 up front, which again can go into different parts of your portfolio. Now, the interesting thing about the 2022 and the 2023 premiums you get, you don't necessarily get taxed on those. You only get taxed, right away. You only get taxed on those when the option expires. In which case, if you were to buy a 2022 if you were to sell a 2022, 2023 put option on Upwork, get that premium, and it expires in January 2022 or 2023, that is a long-term capital gain because you held on to the position for a little over a year. If, on the other hand, you were to sell a put option for the January 2021, that would be in your ownership for less than a year. You would get taxed at the short-term capital rate. So that's something to think about for taxing purposes. And you could also get taxed on it a little earlier. If you don't wait for it to get exercised and you're like, I'm going to buy to close the position, I want access to my $3,500. Again, you buy to close, then you get taxed on that, although that may be a short-term gain, depending if you had the position for over a year or not. So one of the reasons people will sell and buy to close their put option a little early, let's say Upwork has this massive run and goes from $35-ish to $100. In that case, the put option is going to be worth very little, and there's not going to be as much upside left for holding on to that put option. Because as a stock goes up in value, the put option decreases, but the stock massively goes up in value, then the put option will be decimated. So let's say you get the 2023 Upwork put. You sell that to the open, and I'm saying sell to open because that's the order you would do to initiate this. Like you can buy to open, buy to close, sell to open, sell to close. That's your options. Sell to open would be what you do to sell the put option to the open. But let's say you get the instant $1,350 premium and Upwork goes up to $100. And now all of a sudden this put contract, it's only worth, let's say, like $100 because Upwork's gone up so much, or maybe even $200. Let's do $200 for this example. And let's say that Upwork does this within a year. So we're looking January 2022, Upwork's at $100 per share. This is one of the downsides of the put because you missed out on all those gains, but you do get the cash flow, which for some investors is more valuable. It gives them a greater peace of mind, and each investor is different. You got to figure out what criteria applies to you. But in any event, would you want to hold on to a put option like that just for an extra $200 and you have to hold it for a year? Or would you want to buy to close that put option? So you now, even though you got to spend the $200 to close it out, you now have $3,500 that you could put into another option where you're going to make higher premiums than that remaining $200. So that's why some people sell their options very early. I had a Roku put that I sold it and it expired like very far out, like a year out, and I got a really nice premium for that. But I decided to sell early because Roku had really great earnings. The stock continued to soar, and I thought I'd rather own this stock than have the put at this point. I was able to make a quick $1,000 gain because with the further output options, you get more premium instantly. And then if you have a big surge in price, it's not like the put goes from like, let's say, because this was like $4,000 in premium. My God, I sold probably around $3,000, rough numbers. It's not like it goes from like 4,000 to zero very quickly, like you see with an option that expires in a week, but it can go from 4,000 to 3,000 on really great earnings or really great movement. And then that's something where I'd rather get out of that, take the quick 1,000 and proceed to, in my case, I proceeded to buy Roku stock. In other cases, I have just re-entered other put positions by selling puts on other stocks. But the best way to really understand this concept is to just give it a try. There is the temptation to just sell put options on super cheap stocks because that's the easiest way you can enter. But I would only sell put options on stocks where you don't mind having to own the shares. I don't mind having to have another 100 Pinterest shares, another 100 Upwork shares in the event that these options get exercised. But it's a really great path for a lot of investors to make additional income. And it does crush dividend returns. Like the Pinterest example we talked about, a little over 3% yield to 3% return. in a 10-day period. Upwork, we're talking about over 30% return if we look at the 2023 put option. And it's important to also look at like an annualized rate. So like the 2023 put option, like, oh, it's really great. Like I'm making $1,350. But if you do that on a per year basis, then some options are better to pursue than others. Like I would pursue the 2022 put option on Upwork before I pursue the 2023 option, just because I'd like quicker access to the $3,500 so I can continue to put it into other options. But in any event, I'd love to hear your thoughts on this video. Do you sell puts for additional income? Is this something you're going to try in the future? I definitely think everyone should give options a try. I know people are a little scared about risks of option trading. They hear some nightmare stories, but selling puts is one of the best ways to avoid that scenario and make some additional income along the way. Thank you so much for watching the video. We'll see you guys next time.